Now, here is Ticky Fullerton on Your Money.
Hello there, I'm Ticky Fullerton. Welcome to our flagship business show, Ticky, and we've got a huge show for you today as we plough through reporting season. Coming up, a good day for Caltex investors. The big Australian oil business beat guidance and announced a share back today. CEO Julian Segal updates us on those tighter refiner margins for Lytton, his Singapore trading hub, and on his retail network transition at the pump. The battle for the buy now, pay later space. Leo Shanahan talks to Afterpay chair on his results and news that tighter credit laws won't apply. And I talked to the new CEO of rival FlexiGroup, Rebecca James, on her results and her big new investor, John Wiley. And the competition and consumer czar on his feet at CEDA today with his very big to-do list. Rod Sims joins me live to run through his big priorities for 2019. As I say, a very big show. Tech darling Afterpay has swung to a first-half loss of $22 million, despite posting an 85% boost to its total income. Shares have been waving around today, haven't they, this week? The company blamed the loss on the adoption of accounting standards and the launch of new competitors in the UK and NZ. Still, the total value of sales processed through its platform jumped 147% to $2.3 billion. Afterpay's customer base rose by 118% as the company roped in 3.1 million new customers globally by the end of last year. Well, for more on those results, Your Money's chief business reporter Leo Shanahan spoke with Afterpay Executive Chairman Anthony Eisen a little earlier.
We were very pleased to report our results today. We think we've performed extremely solidly in the last 6 months, but probably more importantly, we think we're very well positioned to accelerate our growth from this point, particularly in international markets, but also growing off a very strong base in Australia and New Zealand, where we see quite a lot of more opportunity in our local market.
Yeah, I wanted to talk to you about international movements in a moment, but on your profit, there seems to be some consternation about your loss, about 22 odd million. When do you think you'd turn a profit?
Yeah, I think we've been at quite a pains to go through our profit and loss statement with all the elements that contribute to that. Obviously, there are a number of items in our P&L that are non-cash related and relate to past activities. Seeing through that, I think, is an important thing to do, and we try and disclose that information. Underlying, we've performed strongly with positive operating cash flows in the business, and we've put quite a lot of detail out around that as well. And also from an EBITDA perspective, when you take away some significant and non-cash items, I think it illustrates the leverage in the model and the fact that the business has performed very strongly over the last 6-month period.
There seems to be some worry that about 20% of your income still comes from late fees. I understand that's down to about 17% on the half year, but is that still too much of a reliance on late fees in your business model?
The big difference about Afterpay to other buy now, pay later providers, and of course different to traditional credit providers, is that we make the majority of our income from merchants as opposed to customers. So you will never see in our P&L any other fees coming from the customer. And when you rank it up side by side with any comparator in the market, you can see very clearly that the vast majority of Afterpay's income and revenue comes from merchant fees, and Afterpay is a completely free service for customers when they pay on time. What we're really pleased about is that our model is such that we can positively reward positive behaviour. So if you look at our results for the last 6 months, for example, you'll see that we've maintained our company profitability and our very strong margins, notwithstanding late fees have come down markedly. Our gross losses have come down in as much or the same proportion, which means as a business we're very well positioned to keep focus on making our revenue from merchants and keep going along the positive path in terms of less late fees in the system.
Now, you certainly had a great day yesterday. The share price up almost 20% at one stage. This is obviously on the back of the Senate committee news that you don't have to subject customers to credit checks like credit cards. Where does Afterpay stand in terms of regulation? Are you still in a bit of a no man's land, making you still a bit vulnerable?
We've been very proactive and I think very consistently around the desire for the right regulatory framework to evolve in Australia, not just in relation to Afterpay, but in relation to other non-regulated providers of services. What we're very pleased about is that the Senate committee, but also prior to that ASIC from its own investigations and reports, have concluded and actually highlighted the very clear differences between Afterpay's service and, for example, traditional credit providers. I think the path that's been laid out going forward in terms of working with ASIC and working with industry around developing that framework has really benefited from the investigations that have now gone on for quite a period of time and puts us on a solid footing to develop it. So of course there's more work to do, but we think we can continue to be very proactive with regulators, government, and of course other industry players to develop that framework. We have done a lot of work in the background around what some of those framework elements may comprise, and we look forward to engaging on that in the near future.
One recommendation was around a code of conduct. I suppose if the Hayne Royal Commission has taught us anything, it's that self-regulation doesn't work in financial services. Would this code of conduct, do you think, be enforceable?
I think the code of conduct, as we get into it, is going to be a function of where we get to, obviously, with ASIC and where we get to from a collaboration point of view with other participants in the market. But I would say that one of the fundamental principles, I think, that has come out of the Royal Commission is around this concept of trust and doing the right thing for consumers. And I feel very good about the fact that we're completely aligned with that viewpoint. And because we have such a strong connection with our customers, we're actually rated externally as the most trusted financial service in Australia. I think that's exactly the right foundation to grow and to build from. So elements of the code of conduct and the format of that is something that, you know, as I said before, we're very happy to engage in at the soonest opportunity. We've also been developing framework elements ourselves in the lead up to these report findings.
Okay, to the US, which is obviously a lot of the excitement around your story is in the US. You must be pleased with the customer growth there and the kind of stores that are joining your service.
Yeah, look, we're thrilled with the experience we've had to date. But more importantly, I think we've always been a company that's tried to test and learn from our experiences and then go after the opportunity for the benefit of customers and obviously our merchant partners. We think the opportunity in the US today is very clear. There is a large opportunity and we can see the positive impact that Afterpay is having on customers and merchants. While we have grown fast in Australia and New Zealand, I think you can see from the results that we just posted that our growth rate has been even faster in the US, but more importantly, it's coming off a very strong connection with our retail partners and customers that are quickly coming onto the platform.
Actually, from a US perspective, would it make sense at some point to recenter the business in the United States, perhaps even list in the United States rather than the ASX?
Look, we're a very proud Australian company, and I think to date we're probably the largest consumer-facing Australian tech export based on some of the metrics external parties have provided us with. Look, from our perspective, we really believe that we can grow our business on a global scale, but coming from the perspective of a platform. Our connection with customers and merchants and great retail brands really does have a global application, and I think we've illustrated that from the performance to date. We see that opportunity as being more enhanced today than when we launched in the States, 6 to 9 months ago, and we're very keen to bring that forward. Part of what we did announce today was a conviction around our abilities to do that, and we think that accelerating our growth internationally while still growing very fast in Australia and New Zealand is the right recipe to build long-term shareholder value.
Yeah, and on the UK, you're expanding there as well. Urban Outfitters, the first store there, I understand. That's a pretty good result.
Look, we're happy to expand, obviously, internationally in terms of what we've done in the US. As we've previously announced, expanding into the UK is on our immediate horizon, and we expect to launch there in the second half. What is becoming very apparent to us is that we can serve brands and customers globally on our platform, and extending some of those relationships into the UK really will illustrate that model. So we're very excited for the value we can bring through that development.
All right, well, Anthony Eisen, thanks so much for joining us.
Thanks for having me.
Yes, and look, stick around, because later in the show we'll hear from a fierce buy now, pay later rival FlexiGroup with new CEO Rebecca James. But coming up first, Caltex CEO Julian Segal takes us through his annual result and buyback news.
You're watching Ticky on Your Money. Now, back to Ticky.
Welcome back. Well, Caltex shareholders are set for a windfall, with the company flagging a $260 million off-market buyback due to be completed in the second quarter this year. It's incredibly busy business with many moving parts. It's always a bit of a brain teaser for me anyway. But management's message for analysts: in 3 years, including the buyback, we've returned $1.6 billion in capital, with an overall return on capital employed of 20%. Not bad. Full year net profit was $560 million, down 10% on last year, but still at the top of guidance. Climate is tough, though. There are shrinking refining margins, lower earnings following the Woolworths fuel deal, and costs associated with taking full ownership of some of those sites. Caltex declared a final dividend of 61 cents a share, and for more, I spoke with Caltex CEO Julian Segal a little earlier. Julian Segal, nice to talk on your full year results, and the market's up 4% as we speak.
It's a good start for the day.
Well, it's such a complicated business, as we know, but cutting through that, is it because, do you think, you beat guidance, or more because of the share buyback you announced?
I think that we had a very good year. It was an important year for Caltex, and really the highlights for me is what we delivered, for example, in fuel and infrastructure. If you take the Lytton impact away, which was pulled down by the refinery margins, fuel and infrastructure delivered an increase of 21% in profitability. So that's fantastic.
And international as well.
So internationally, we are selling now 3.5 billion litres. EBITDA 75 million, which is an increase of 172% compared to the year before. And overall volume internationally increased by 39%. So what we've got there is a business that is resilient, is generating cash flow. And at the same time, we've got a business now that is coming up with a new convenience model. I think this is a great combination, a strategy that is basically built on a strong, resilient business and a future in convenience.
So do you see your international business as an EBIT contribution as a whole growing in terms of the overall number?
Certainly, this is a platform for growth for us. And if you look at our acquisitions in Gulf, New Zealand, in Seoul in the Philippines, certainly we're meeting and beating business scenario.
Well, let me first come to the Lytton refinery. Now, that in the last 6 months has been a bit of a problematic child for you. I think you had one incident in October, and then you had another one in January. So what are your plans for it now? Because I think the October incident was a $20 million hit. What are your plans for this now?
So what we had actually is an external factor. It doesn't reflect in any shape or form on the reliability of Lytton as a power failure from the supplier. And so all that we are doing is, as usual, optimizing our refinery. We are optimizing our refinery every day to take advantage of the refining margin at the time, and that's when the refining margin is very high or very low. In this particular case, taking into account the refining margin, we'll make a decision if it's worthwhile bringing forward maintenance or not.
Now, your refiner margins have been squeezed, and I know your head of fuels and infrastructure, Louise Warner, was cross-examined on this quite closely. She wasn't going to give an outlook for the next half or the full year, but her comments did seem to be perhaps more optimistic than some in the market.
I think it's worthwhile looking at history. History is a good indication of what's going to come, and clearly I cannot honestly give you an outlook on refining margin for the next few months. But what we do know, if you look at the last 10 years or more of refining margins, in the same way they go down, they come up again. And pretty much there is a platform below which they don't really go for too long a period of time. And therefore, my view of Lytton is we are looking at Caltex as a whole as a very resilient cash flow generating business. Lytton is making a good contribution even in difficult times. But in some years, it's going to deliver a much richer result. And this is a bonus.
But your CRM in February, have I got that right, it's a $6.61 a barrel?
Yeah, it's about right.
And the break-even is about $6 a barrel, even.
So what we need to really keep in mind, cash is king.
Yes, and that's $5 a barrel.
And it's $5 a barrel, so we're still making money.
Yes, but if your refiner margins are tight, if I got this right, you might look at a proactive shutdown sooner rather than later.
Could be. Okay. But there are many reasons for us to do something like that. I think the important thing for the investor to know is that we do optimize that refinery in terms of what crude we bring into the refinery, so we can produce, for example, more diesel and jet fuel rather than gasoline, what intermediate products we bring in and out of the refinery, what we buy as finished products as compared to what we make.
Right. Look, we always talk about the refinery, but it's actually the lowest contributor of all the different businesses. What about your fuels and infrastructure business, taking out the Lytton refinery? What drives that business?
So that is a business that, first of all, has got a very strong base in Australia. We are the biggest fuel supplier in Australia. We've got the biggest retail network. And that is very important because we have security or a large volume that we sell into Australia. Based on that volume, we're able to build a trading and shipping business in Singapore, who is now capable of servicing outside of Singapore. So we're supplying Gull in New Zealand, we're applying Seoul in the Philippines. In fact, we're supplying into more than 12 different countries.
And the B2B side is really making progress.
The B2B side in a very competitive environment. So our volumes, wholesale volume to B2B in Australia, with the exception of Woolworths, grew by 10% in a competitive environment. So I really think it's pretty good. Louise is doing a great job.
Now, Julian, you say 2019 is the year of transition, and you're going from 65% to 99% ownership of your retail outlets. You've recut the deal with Woolworths. Now that's a hit, isn't it, in terms of repricing?
Well, it depends how you look at it, half empty or half full. The reality is the market assumed, and rightly so at the time, that we lost the whole volume. The reality is it's not that we took a hit, but we regained a significant volume, some 5.5 billion litre out of a total of 20. So actually it's a significant gain for the company. But of course, when you compare year to year, you will see a decline. And we took a hit of $35 million in 2018. But the reality is, the good news is we've got this volume, which is enabling us to grow internationally. The other thing that you should remember, it was not just a fuel deal with Woolworths, but it was a strategic convenience alliance, and that's really important, and it's delivering a lot of value for us. So, for example, in November, we rolled out on our sites the Woolies loyalty scheme. So customers now can earn points by buying at Caltex. People like it. Customers really like it. We doubled the number of sites where they can get the 4 cents a litre Woolies discount. Customers love it.
There was a lot of focus by analysts on this part of the business today. Now, some of them would say that you've been in transition here one way or another for quite some time. How can you be confident of your objective of 120 to 150 million EBIT, given that we're not really talking about the 30 million at the moment?
Very good question. I think we need to go back and remember who we are and where we're coming from. And we've been a very successful, and are a very successful fuel retail business. And that's the focus of our retail. So that's still the case. And we made progress in 2018 where we increased our profitability on fuel retail. What we said a couple of years ago is we can see the changes, technological changes coming. We can see the electrical vehicles coming, not tomorrow, but 10, 15 years' time. In a typical way, Caltex looks long-term, and we said we need to build another retail leg to our business, and rightly so, we put our money on convenience. I say rightly so because I'm sure you've heard a lot of commentary over the last few weeks of the changes in the behavior of Australian consumers, where they prefer to buy more frequently and smaller quantities. So convenience is a growing segment, significantly so. Now, you talked about we've been at it for a long time. We've been at it for 2 years. Yes. So 2 years ago, Foodery was a plan on a piece of paper. It was in February 2017 that we rolled out the first one.
Yes.
We've got 57 now, and tomorrow we'll open the 58. I think by any stretch of imagination, to roll a new format in 2 years and compare it to any player in retail in Australia, it's remarkable. And what's even more remarkable, if you look at the sales increase at Fooderies that have been operating for more than 6 months, it's at least 40% increase on our sales.
All right, so this time next year, we're really going to see the rubber hitting the road here.
Absolutely.
That asset optimisation, you decided not to go through with the sale and leaseback. You've got a new chap in charge of it. What are you going to do with it?
So that's why we've got David to make a decision. So it's not that we decided not to do anything. What we are doing is thinking what additional options we can look at that we haven't looked in the past. The rationale for us to sell those assets into a vehicle such as a REIT would have been to create headroom for debt in our balance sheet, enabling us to do buyback, which we are doing anyway, yes, or invest in a new business. The reality is that using the vanilla structures, if you like, available to us, it does not create any debt headroom. So it doesn't make sense to go ahead and do it just for the sake of doing it. We are, however, in a position to look at additional opportunities, or options, I should say, and as we come to a conclusion, we'll inform the market.
Right, so nothing yet?
Nothing yet.
Right, now you've announced your share buyback. You're paying a fully franked dividend. Now, obviously, that share buyback is going to help your return on equity and your earnings per share. Are you also doing it because of the possibility of a Labor government and what might happen with franking credit?
Really, we're doing it simply because we are very disciplined in our capital management, and we said all along for the last 10 years that our first priority is to invest in safe and reliable operations, and that means maintenance, for example. We don't compromise on that. The next thing that we are doing with our capital is to invest in growth opportunities, and we only do that if we can figure out there are good returns. And I'll point out for the last 3 years, our return on capital employed has been 20%. And then what we are saying, if we do have additional capital, we will return it to the shareholders, which is the right thing to do, and that's what we've done.
Julian Segal, well done on the result, and thank you very much for joining me.
Thank you, Ticky.
And after the break, ACCC Chairman Rod Sims on the Competition Watchdog's 2019 priorities.
This is Ticky on Your Money, covering the big business stories.
Welcome back. Well, the ACCC is embarking on an ambitious year ahead. Chairman Rod Sims today outlined the regulator's 2019 priorities in Sydney at a CEDA event. And I'll outline some of them. First being competition enforcement. Mr Sims says the watchdog will aim to have 2 to 3 criminal cartel investigations come to conclusion and prosecutions commence each year. They'll be focusing on misuse of market power and concerted practices provisions. The ACCC will also be focusing on consumer law enforcement priorities. This dives into work already started on telcos, loyalty schemes, white goods and a new focus on social media advertising traps. Next, the ACCC will continue its key product safety focus, the standout this year being Takata airbags and quad bike safety. Ongoing will also be the ACCC's market studies, diving into electricity pricing and affordability, gas prices, digital advertising, and a new one, the consumer data right, which aims to give consumers the right to pass on their data to third parties. Lastly, the ACCC will continue its advocacy efforts centred around unfair conduct, privatisations, unfair contract terms, and airport regulation. Phew. Well, for more on these key priorities, I'm pleased to welcome Rod Sims himself. Joins me live at the desk. Rod, I don't know how you're going to do all this year, but...
We'll manage it, Ticky, we'll manage it.
Quick one off the top. Kenneth Hayne and the Royal Commission put a rocket up under the other two regulators, APRA and ASIC. Changed your view or approach at all?
Look, to be honest, not really. I mean, we just do what
you had teeth to start with,
well, look, I'm not going to comment on other... different regulators do different things. As we know, APRA is a prudential regulator. ASIC is the corporate regulator as well as the financial regulator. They've got their tasks, they do them their way, we do ours. But
you have been more litigious in the past than them. Kenneth Hayne is now demanding that particularly ASIC gets more litigious. Yes. Any advice there?
Well, we just take the view that we're not companies' compliance departments. We're not there to give them... we're happy to educate people about the law, but we're not there to work out whether or not they're complying. If we work out that they've breached the law and they're big enough and the behaviour's egregious enough, we'll take them to court. That's absolutely what we do, because we believe that sends a deterrence message to them, that sends a deterrence message to the wider community, and it also tells the public that we're doing our job.
You're also precedent-setting. I know now the entire business community will be watching this criminal cartel investigation, the case the CDPP is bringing involving ANZ City, Deutsche and 6 officers. You're obviously confident of that, otherwise you wouldn't be putting it forward.
Oh, look, we go through a long process, Ticky. We investigated that for probably from start to finish a couple of years. Then,
it's very new territory, sort of dipping into what the syndicate should and shouldn't do.
Look, I don't want to get into a case before the court, Ticky, but we think it fits... our allegation is it fits very squarely under the criminal cartel provisions. The CDPP spent 6 months looking at what we'd done. In a sense, unfortunately, now it has to go to a magistrate's court before it gets referred to the federal court. So it's a very long process, which is obviously long and difficult for everybody involved.
Right. Consumer protection, electricity and telco pricing, you have been on for months and months now. You say it's still too complicated, still too opaque. Even after the government this week has announced the cap on default offers.
Well, that's been very helpful. I think what this shows is, as a regulator, we need to be both enforcing the law, and we've taken all the electricity regulators to court, all the main ones, over confusing customers and misleading customers. That didn't solve the problem. We did the retail electricity pricing inquiry, recommended to the government the default offer and the reference price offer, which they've now adopted, and that will make a big difference, Ticky. So it'll make a difference. It'll help competition in the entire market, and it will help consumers in the entire market, because you'll have clarity around offers. So we're really keen on what's happened. Now we're going to monitor to make sure that it happens as it should.
You took a step back during your speech, a slight window onto your thinking about this. You're really concerned about affordability and welfare-based considerations rather than just competition-based considerations. I'm wondering, in the energy space, should energy retailers just really give up, aim to break even and try and find another space to make a profit?
Oh, look, Ticky, I think, we're really pleased with what the government did. They've followed our recommendations.
Yeah, they have.
It's churlish not to be. But the point is, they've set a sort of a default offer that you can't really go above, but that's set halfway between these ridiculously high standing offers, which they know themselves they should never have been charging anybody, and the average market offer. So there's plenty of room for discounting, plenty of room for innovation, plenty of room for competition to give consumers good offers. So we think it gets the best of both worlds. And if you use that as a reference price, then in future, Ticky, when you go and buy your electricity, you'll know that a 30% offer is better than a 20% one, and you've got no idea right now.
Okay.
So it's going to help the whole market.
You did this preliminary report into digital platforms, huge report review,
Yes.
and the final one's coming out mid this year. The world is watching. You've said that the report identified a, quote, number of potential enforcement issues under investigation. We expect to take some cases on this year. Are there any particular areas of concern?
Oh, look, we've got issues in relation to competition, and separately we've got issues in relation to consumers being misled. So given their investigations...
So it's those sorts of cases that you'll be taking on?
Yes, but the bigger issue out of digital platforms is going to be the recommendations we make to government for action. That's where, you know, the bulk of issues are going to come from. But yes, these enforcement investigations are also very important. So the combination of the two, I think, will really move the dial in relation to these digital platform issues, which are really important.
Rod, advocacy, lots of areas, of course, but harsh and unfair conduct.
Yes.
I mean, you lost the case against Medibank. The judge was saying, yes, harshly, yes, unfairly, but not unconscionably. Now, that wouldn't pass the Hayne test, would it?
Well, I don't think it would, no. And that's interesting. The Hayne context is, I think, a good relevant backdrop. So consumer law says don't mislead consumers and don't engage in unconscionable conduct, conduct without conscience. High bar. The question that needs to be addressed
because you lost.
Well, and the judge said it was harsh and unfair. So the question is there a gap that the law needs to fill? And, you know, you need to talk about what you mean by unfair. So that's an issue we're going to pursue. All right.
I must ask you about banking and competition generally. Obviously, Kenneth Hayne had lots to say there. You're focusing particularly at the moment on FX.
Yes.
And then, of course, we've got open banking. Tell us a bit about this work you're doing on consumer data rights, because open banking or shared data has to be in place by, what, June next year?
Well, the legislation has to pass Parliament, and that's interesting in the run-up to an election. But the important thing about consumer data right in banking is that at the moment, if you want to get an offer from another bank, you've got to go to a lot of trouble to fill in forms, tell them all the things they need to know. This will allow you to say to your bank, give me my data, I send it to the other bank and I say, can you do me a better offer? You can do it in an afternoon.
Safely?
Safely? Absolutely. No, safety will be really important, no doubt about that. But you know, the difference between what you're paying if you don't ask your bank for the best deal and if you do is enormous, thousands of dollars. So again, Ticky, it comes back to that issue we've talked about before. You know, the sort of loyalty tax. The more you stay loyal to the firm, the more you're paying. I mean, do companies really want that outcome? Do the companies want people knowing that loyalty means they're paying too much?
This is how market works. Nobody gets a raise these days unless they move employers, do they?
That's right. Look, I understand why it's happening. I just think companies might have to think about their brand. You know, the number of outraged letters I get from businesses and consumers. I've been loyal to this company for 10 years, and now I discover, had I asked, I'd have saved thousands of dollars. Aren't they supposed to be looking after me? I mean, it's just I think it's an interesting philosophical issue, but one companies need to ask themselves as well.
All right. I know you've got issues with privatisation. We've talked about that before. But airports and airlines, Rod, we've had the Productivity Commission's report out on the airports. Now, amazingly, this is something that Virgin Australia and Qantas are totally aligned on. They think it was a terrible report.
Yes. Well, look, airports aren't regulated at all. We felt that we had a pragmatic, dare I say, clever idea of just saying, well, look, if the airlines and the airports can't agree, then they've got the right to go to commercial arbitration. That would be a right under law.
That hasn't been recommended, has it?
No, no. But we thought it was a very light-handed sort of regulation. I mean, it's not us setting their prices. It's not us being the regulator. It's not us doing the arbitration. It's a commercial arbitrator. Good commercial arbitrators knock this sort of stuff over in a couple of months. We thought it was pretty low-key, but no, the Productivity Commission didn't agree.
And you reckon prices have come down? Because the airlines didn't seem to think... I mean, consumers always think that parking is incredibly expensive at airports and food and...
Yeah, oh, well, look, that's another matter. But across board. I mean, airports make a lot of money because if you put them all together, they're charging the airlines for the aeronautical, the landing strips. They're charging the tenants there for the...
Well, they've got to capture the audience.
And they're charging you for car parking.
Yes.
So it's a pretty good business and profits keep going up and up. Look, some charges came down this recent year. I always find it interesting when there's a Productivity Commission review underway that prices come down. But anyway, it's a pretty easy business to run. I think our idea would have, put a bit of competitive pressure on them, that have known that they had to watch themselves because they could be in front of a commercial arbitrator. Just that little bit of pressure would have been useful. We'll keep arguing with the Productivity Commission.
All right. Finally, can I ask you, this is just some of the things that you talked about in your Seed for Address today. It's a huge amount of work. I know you've got a special team to do the digital work.
Yes.
Are you resourced enough? How are you resourced to be able to do this?
Look, there's two stories, Ticky, just quickly. When we get extra studies like the digital platforms, electricity, gas, we get extra resources, and the financial sector market studies. Where we are suffering is our base resources. I've got 70 investigators for consumer law right across the country, and about the same in competition. So,
and that's to cover all sizes of companies.
That's to cover all companies right across Australia in all sectors. So it's pretty thin. I think Australians would like us to be better resourced so we could do more. If we had more resources, we could do more.
All right. Well, this is the climate to rattle the tin, I think, Rod Sims.
Any help you can give us, Ticky, would be gratefully appreciated.
Well, thank you so much for coming in. So
Thanks,
interesting
Ticky.
What you're up to. Thanks very much. Right, after the break, competition heats up in the buy now, pay later space with my next guest vowing to take on Afterpay. FlexiGroup Chief Rebecca James joins me next.
Now, back to Ticky.
Yes, welcome back. FlexiGroup is on a mission to reclaim its ground in the buy now, pay later space, with investment banker John Wiley pledging his support for the strategy. Mr. Wiley's Tanara Capital has injected $21.5 million, no small amount, into FlexiGroup to support the company's turnaround plan after 3 years of negative growth. The company released its half-yearly results today, net profit falling over 22% to just under 32 mil. But looking forward, and the company sees its full-year net profit at between 76 and $80 million. FlexiGroup CEO Rebecca James joins me live at the desk. Rebecca, welcome. You've just come on board
I have.
in August. Now, this must be pretty nice. Up 7.7% today.
I know. It's a good result. We're pleased to see it, and the market endorsing our new strategy today.
OK, so you've had a write-down, though, but that was on your leasing side. Peeling it back, your underlying sort of net profit was just up 2%, 41.9. So
yes.
Fairly modest. Even
yes.
so.
Yeah. Look, we have had strong double-digit growth in our key metrics. So customer volumes up, receivables up, number of partners up. But there's far more opportunity for us in this marketplace, and the strategy today unveiled where we think we can take that. Right,
this is your turnaround strategy. Now, so if I'm an investor, we had Anthony Eisen on earlier from Afterpay, so if I'm an investor looking at this space and looking at you guys as opposed to Afterpay and indeed Zip, why you?
Yeah, look, I think the first thing in terms of the way that I see the business, Ticky, and I don't think a lot of investors know, is that FlexiGroup offers a range of different financial services products.
So it's not just buy now, pay later?
It's not just buy now, pay later. And so we've got products that suit a variety of purchase occasions. Yes, consumer and SME leasing, credit cards, and buy now, pay later. As Australia is experiencing a lot of growth in buy now, pay later as a category, there's a lot of interest in that product.
Can you fund the growth strategy? I mean, Afterpay's got a huge growth strategy out in the US and all.
Yeah, we've got an incredibly strong balance sheet. I think the important thing for us in Buy Now, Pay Later is that we actually invented the product. We've been in the market for 20 years. We're a market leader when it comes to receivables and also profit. We've got a healthy product, healthy profit in our Buy Now, Pay Later product.
I mean, you're looking at taking on Afterpay and the Buy Now, Pay Later. It's one of your businesses, but you're looking to grow that sector, obviously. Is it the same sort of business model? I think I earlier heard Anthony Eisen saying that they were pretty much alone in terms of this model of charging merchants so the customer doesn't actually pay interest.
Yeah, look, the strategy that we announced today is the merging of two products. We're calling it, you know, Hum will be the only product in the market that serves...
This is your new brand, Hum.
Yeah, our new brand. So we span transactions from $1 all the way to $30,000. And we'll be the only product in the market that can do that.
Yes, you go much higher.
We do. For transactions below $2,000, which we call the little things that you can purchase under Hum.
Which is where the market's at for the competition.
Correct. There'll be no fees to the consumer.
Right.
For transactions above $2,000, there will be a monthly account keeping fee, but that monthly account keeping fee remains unchanged regardless of how large the transaction is that you're funding.
Okay, and how much is that? Roughly?
It will be $8 per month.
Right. Okay. So, and what about your business model? Do you, like Afterpay, make say 17%, I think, from late payments?
No, less than 3% of our revenue comes from late payment fees in the products that we have in market today.
All right. I must ask you about your new investor, John Wiley. He looks like he's very canny, isn't he? He looks like he's almost made his money back. I mean, if you look at the share price, I think we might even have a share price graph somewhere. It's actually come down in the last 6 months, your share price, you know, dramatically, obviously. John Wiley bought in and it's just gone up, and he bought at a 10% premium, which is odd being an investor. Normally you buy in, you know, not quite at that sort of premium. So what is he looking for, do you think?
Yeah, look, we've been working on this strategy that I announced today. I've been working on that strategy with the team pretty much since the day that I started last October. And we're very pleased to see, firstly, the endorsement of Tanara Capital in that strategy in the market today, and also support of that strategy from the broader investment community.
Right. So he's a fellow, he's an interesting fellow. He's been sort of tickling up the whole grain core space, and he's been saying that he's got a new approach to investing in listed companies, more collaborative than activist. Now, do you see anything in John Wiley's approach that sort of supports that?
Look, we're delighted to have John being appointed to the FlexiGroup board. My belief in business is always that better outcomes come as a result of greater debate, and particularly in the realm of creativity when it comes to strategy. That's very much the spirit in which the FlexiGroup board operates today, and I'm looking forward to that spirit continuing into the future. Right,
so growth, interestingly, you've already got, you also got a new partner you've announced today in Premier.
Yes.
Solly Lou.
Yes.
So you've locked down Solly Lou and John Wiley in Melbourne. That's not bad, I suppose.
I know, it's been a good day at work today.
But millennials, because that's a very important space, and that's where Afterpay's growth has been. Is that what you're planning to do through Premier, is to access millennials?
Well, firstly, I think the market underestimates the number of customers that we currently have using our Buy Now, Pay Later product today. Is over 1 million customers. That customer base stretches over a broader demographic. And actually, in my conversations with retailers, what's of interest to them with Hum is access to that broader demographic. So we actually see it as a core strength of ours.
Okay. Now, briefly, let me talk about the regulation, because obviously the big heavy stick didn't come through. Afterpay is delighted because being its clients have lower amounts of money. They haven't got the same checks in place that you do. You are pushing for a code, an industry code with quite onerous self-monitoring. Now, is that to make life difficult for Afterpay? I mean, is this more a commercial thing than
the onus of the code is really to protect the goodwill that the Buy Now, Pay Later category has earned from consumers. It is a fantastic product construct. Paying no interest forever is something that consumers have really bought into, particularly budget-conscious Australians, and we want to ensure that we protect that goodwill moving forward. Self-regulation is a way for us all to ensure that we maintain a high standard, we protect that goodwill.
But you're doing this already. in a canter.
In some of our products, yes, we are. But the proposed framework that we've put forward for self-regulation expands beyond purely the checking side. You know, of course, we want to ensure that customers that use these services can afford and have ability to repay. But the proposed framework covers other areas as well.
Rebecca James, very nice to talk to you. I'll enjoy talking to both you and Afterpay going forward this year. We'll see how you get on.
Wonderful. Thank you, Ticky.
Australian workers are facing 6 years of little or no wages growth, according to a new report. The International Monetary Fund says our incomes are only expected to rise by 0.3% per year, adjusted for inflation. Well, that's well below the national average of 1.8% since the 1960s. Economists are blaming subdued labour and business growth, partially due to a lack of political reforms over the past decade. But Treasurer Josh Frydenberg says the IMF gave Australia's overall economic performance a big tick. Well, for more on that, Evan Lucas from InvestSmart joins me live from Melbourne. Evan, is this much of a surprise, this wages news?
No, I don't think it is, and I think you've been listening and hearing this. You know, last week's a prime example. We saw that the wage price index. You had to listen to what's going on in employment. That they are showing you that it's so incredibly sluggish. Now, yes, wage price index for the last quarter did bounce up. You are seeing it move away from those lows that we saw at the back end of 2017, start of 2018. So that's nice to see. But at 2.3% year-on-year growth, as you just alluded to, that's well and truly below expectations. If you then drill right into it and have a look at the private sector, it's at 2.1. The other part of the result that you can start to see is that those wages are ex-bonuses, and bonuses have been where you've seen the real pullback because, as you alluded to, business productivity is really, really fine. So they don't just harp on around about the fact that you've got policy issues. You've also got the inability for governments to have actually moved with the times around globalisation, and that's the next part of the whole question they put is not just globalisation, but efficiency around things like AI, so artificial intelligence, where that sits in it, and also just general overall service areas are clearly under a lot of pressure globally. So competition comes on the back of that as well.
So what do you think Philip Lowe's thinks of all this over his cornflakes?
Yeah, I think you're actually starting to hear him say that this is his concern in terms of where it is. And you can see one of the best charts I saw last week was actually the Phillips curve between Australia's employment market and Australia's wages market. And it's the biggest gap in the world in terms of we've got a very, very strong employment market at the moment. We've seen that. We've got unemployment down to 5%. And he's arguing it could even be low as 4.5% if you take out a few factors. Yet we've got very, very low wage growth compared to that. And it's the lowest in the world with that kind of numbers. So I think he is aware of that. I think that's also why he has, in the last 8 weeks, from the December meeting to the February meeting, and we get to hear what he says next week for their new meeting for March, that their opinion has changed. Now, they believe that the unemployment rate may fall to 4.75% at December this year. But he is worried about wages, and he is worried that that's not flowing through like it should, and therefore not flowing into the economy.
All right, Lassie, can I ask you about iron ore prices? Because there's been a lot of talk. Obviously, we've had Vale, the big Vale issue. Where do you see them going forward? What's hitting them?
Yeah, so look, obviously today we had a fairly big hit to it, but it's dropped from $91 a tonne to $85 a tonne. The reason iron ore is so interesting at the moment is that it is so far ahead of expectations in terms of where it is. What's also probably not really being questioned, but was very interesting from earnings season, listening to our big miners here, they're not increasing supply like they have in the past. So when you've seen prices go up like this, your BHPs, your Rios have tended to chase the price and grab it. They're not going to do that. They've told you that they're going to actually continue to hold supply at current levels. And that would suggest that they could actually keep the price at a slightly elevated price to expectations over the forward estimates. It also means the government is likely to show you a bigger surplus come their May budget. So at the moment, back at the envelope calculation, the average iron ore price at the moment sits at about $71 a tonne. My EFO was giving it 55. Back of the envelope calculation says it's an additional $4 billion to the budget bottom line. And that's why iron ore at the moment is watching very, very closely by a lot of pundits, not just market players like myself, but the government is clearly watching it as well.
OK, sorry, just slip in here. The ALP bank levy, what do you reckon?
I think it's a good idea, to be dead honest with you. I think it's a very, very good idea if it's done correctly. And that's the only caveat to it, is that if it is going to go towards additional counsellors in finance, if it is going towards some form of compensation, then absolutely that should be the way forward. The retrospective aspect of it might be tough. I think also the way and who controls it is the next part of it, and that's clearly still, part of the policy we haven't heard. But overall, if we can provide better financial counselling to the general population, that has to be seen as a good thing.
And it's not, you're not going to ratchet up once you've got that sort of levy in there. I mean, we've already got one bank levy, of course.
Correct, and that's the way to look at this, is that this is a more direct sort of cause and effect, if you want to sort of argue what it is, instead of being a taxation levy, inverted commas, and then finding its way back in through the overall tax system. This is levy, goes straight to, obviously, financial counsellors. So I think that's also why it is a positive. Again, the caveat for me is who controls it. If it goes through a government organisation, fine, as long as there's no partisan issues that come with it. And that's the main part. As long as it's an independent government body that regulates this, I think it's a very good thing.
Evan Lucas, great to talk as always. Thank you so much for joining us.
Thanks, Ticky.
All right, well, that is all for the show tonight. Tomorrow night, Craig Scroggie, next DC CEO. Until then, thanks for your company.